Welcome to session 8 and 9. This is about tech and product evaluations in deep tech companies. And we have Shamik Sharma, who will take us through the product part of the evaluation, and I'll talk about the tech evaluation later on. Shamik is a venture partner with us and also runs Cult Gear for CureFit. And he has been associated with us for the last 3 years or so. And Samik will introduce himself, but just one word on our association with him is that I think his clarity of mind has always amazed me when I've worked with him on so many different discussions. And I think one of the finest product brains in the country. So, everyone, please utilize this time to pick his brains on how to do product evaluations, especially his background spans over startups, big companies, deep tech companies, brand companies, and so many other things, right? So it is a very wide view of how to look at products that he brings to the table. So welcome, Samik.
Thanks, Manish. A very generous introduction. I'm quite honored to be here. I mean, I think this is a great initiative. I was looking through the backgrounds of some of the folks in this program, and clearly, you don't need me to tell you about product. This is, you all are very, very qualified, having many of you having built startups and companies and products in your own background. So what I will actually be sharing more about is how to evaluate products, and that may not be something you've done in the past. You mostly build products, and it's a slightly different skill. So my talk will be tilted towards that aspect of it. So I have a presentation. I'll just start sharing that right now. But the talk is intended to be very interactive. So I'll pause after every 2 or 3 slides where I will take questions, and then we'll move forward again. Okay. See, so just a brief introduction about myself. You can look at my career in just 2 parts, right? One of them was in the US, 15 years in the Bay Area, and then about almost a decade now in India. And I started off as an academic, wrote lots of papers and patents. And I think this still haunts me because everyone thinks of me as a deep techie, and I probably am. I'm an academic at heart. But over the years, I've kind of shifted more towards becoming like a product person. But I always start with the technology at the core of it. I was an entrepreneur. After being an academic, I started a software company, security software company. It was sold to Oracle. And then I worked as an executive in various B2C companies at Yahoo, at RockYou, which made social games. Also worked in consumer hardware. We built a light field camera. For those of you who don't know what a light field camera is, it's a camera that operates much like an insect's eye with 1,000 or with 1,000,000 lenses within it instead of just one lens, like say in your typical camera, and that allows you to do a lot of complex stuff. The last decade has been primarily in India, where I was at Myntra as a CTO and CPO for almost 7 years. Have a very close association with Mukesh during that period. Around 2013, I also started angel investing in India. These are pretty small checks, about 10 to 25K. And out of those 12 investments, like any angel investors, I wouldn't say I have a very good batting record. 4 are dead. 1 has been acquired at a decent acquisition. 4 are doing okay, and 2 are doing good. I won't name which ones are good or not in case they listen to this recording. I would say only 1 of them is grown over 10x, right? That's Scriptbox. That was one of the initial angel investor. But it's still too early. I mean, this is the thing about this game. It takes a long, long time for the record to be clear of how you're doing. But the more interesting experience that I think I'll kind of stress more upon, because the angel investments are done for various reasons. I'm happy to answer questions on why the motivations of angel investors, which are very different than VCs. But more closer to what you guys are looking at is my stint at a venture studio post Myntra. And a venture studio is more like you can call it an incubator, but it operates very differently. And there I would make investments in 8 projects. Relatively small check sizes of 50 to 200K for 5 to 15% of equity. And out of those 8 projects, 5 are dead and 3 are alive, doing quite well, which is a decent hit rate. And there, the operating principles and how you evaluate product and how you decide where to invest is more like the VC game. And I'll draw upon some of that during this talk. More recently, I've been working at CureFit, where I work on several strategic initiatives. I won't talk much about that, though I did give you one or two examples maybe. But that's a health tech company working in many different spaces in health. Okay, so to move on to the real content of the slide, before we go into like product, I just want to set the context. See, product is a very small part of the entire decision-making process, right? You have to look at the team, you have to look at the market, you have to look at the product, you have to see how much capital is needed for success in this business. What is the timing? What might be a great idea, great team, great market, maybe just the wrong timing. You might want to do it. You might have wanted to do it 2 years ago or 2 years later, but at this particular moment, it might be not the right time, right? So all of that goes into some, big evaluation framework. And then, you either make dollars or you don't make dollars, right, out of the thing. And the complexity of the game is that, you can see this like a machine. And each of those rows on the left-hand side are, the 5, if you were to give a framework and say, okay, I'm going to give it a green, a gray, or a red, right? Depending on whether the team is, so the first dot on the left, on the first row might stand for the team, right? Each row stands for a company or a deal that comes to you. And you're going to evaluate it on whether the team is good, the market is good, the product is good, et cetera, et cetera. And every time you find something that you really like, okay, the market is really good, you give that a green or a dark green, right? And so on. So basically that's how the entire system looks like mathematically, right? You have a deal flow coming in and you're making portfolio choices, and each of your portfolio choices is never going to be perfect. It's either going to be all of it is kind of middling, which is all grays, or some of them is really spiky and a green, but there is some other red aspect because the timing is bad or so on. And given all of this input, you have to make a choice, right? The problem, of course, in this evaluation is that the feedback cycles are very, very long. I mean, these we're talking 7 to 10 years. And so you really, what you think is a bad decision might actually turn out to be a very good decision. What's a bad, looks like a good decision for the first year, 2 years, 3 years, 4 years, suddenly turns bad. And so there's very spiky inputs. Like some of these things are, the team is really good, but the product is really bad, and so on. And the fact that you have to make hard yes or no decisions. These are type 1 decisions, as Jeff Bezos calls it, right? You can't really, once you've invested in a company, you can't uninvest in it. This is not like the public markets, right? So this is what makes the whole thing complex. And that's why I don't think this is a arena where a lot of algorithms or a lot of frameworks will work, right? So even though I'm going to talk about a framework, I wanted to caveat all of this by saying that I really, my own opinion is that frameworks and so on are of limited value. And what you really need is that you need to be able to always juxtapose between whether you believe in something or you're a skeptic about something. And no deal will come to you where you're always just a believer or just a skeptic. You have to sleep over it and you wake up the next morning being a skeptic, and then there's some aspect that you read about and that makes you a believer, and then the guy gives you a really good pitch, your belief strengthens, and then you talk to somebody else and he says this guy sucks, and then you become a skeptic. So you're kind of switching between these two things. And at the end of the day, right, the quality of a good investor is on this judgment. How good a judgment you're able to make. And while frameworks and all of that can help, right, at the end of the day, by and large, you're looking for spiky things, like some things in which people just excel. They're hitting it like out of the ballpark, not even in the zone on the playground where other people are operating. At least in some areas, they have to be like that. And then you have to make an intuition, an intuitive gut call. Right? So this is what the overall context of the game is, right? I'm not just talking a product, but the entire VC game. And while there's a lot of things you cannot control, what you can control is the deal flow. And that depends on many aspects, your record, your founder relationships, etc. That can control your input quality. And you see the best VCs getting the best deals because the best founders go to them. Right? The second thing is process. Once the deals come to you, you can have the people that have a good process tend to make better choices. And here the main thing to see is how are you able to identify where it is a spike, either in a positive or negative direction, and how you're able to identify that in good speed. And the way you can often do it in high speed is if you have done a lot of pre-diligence and you've understood the market already very well. And that's why specialization helps in this business. And you find certain VCs who are good in certain things because they understand that market and are able to quickly make a decision once they see a founder or a good team, within days, even in some cases. And then, of course, what investors can control is how they help post-investment. And, VCs will say that they help in, XYZ, many, many things. At the end of the day, my own opinion is mostly what they help out in is in capital, in helping, get you connected with other investors, second, next stage deals and so on. And in, getting the network of other founders, other employees, other experts so that you can talk to them. In a pure operating role and actually helping you with the product, helping you with channel distribution and the value is pretty limited that a VC can help out a founder. Even for the VCs that come from operational backgrounds, reality is that you will not be there in the thick of things, dealing with the day-to-day issues and understanding all the little knobs and things so that you can make rational, actual decisions without having all the data. So now I'll go into product evaluation, but before I go into that, I'll just pause and say any questions so far about overall the game itself before we get into the product specific parts. Any questions?
I think we can
All good so far, Shamik.
All right. Great. So this is the real meat of the talk. And, the main thing here is that, again, to give you context, we're only looking at one column of the deal flow, which is the product evaluation. But of course, your judgment has to be based on a lot of other factors as well. And what you're going to evaluate is a series of fits. And people usually say product fit, but product doesn't operate by itself. It operates in the context of a market, how you go to market with a product, and the business model that that product entails. And I've sent out a pre-read that I tend to, I've liked a lot and I've used throughout, which is known as the Balfour framework. And basically it operates like this, that, don't think of it as a product market fit, which is the common terminology that most people use, but as a series of fits, right? So first of all, and this is pretty common for product managers, they know a lot of this. It's been well documented and debated in the community. But I'll actually be using the same framework with a slightly different angle of what the investor should look at, right? Which is similar to what the founder looks at, but not always exactly the same. And so, there's a bunch of things going on here, and we'll go through each of these fits in turn. But because we're talking of deep tech, early stage investing, I'll focus on the first two or three more than the latter two. You can read up on the latter two fits and on the URL that's there at the bottom. And before we go into the details, I'll just talk a little bit about what the meta questions are. Of course, there's a lot of detail behind each of these things, but at a high level, what does each of these fit really mean at a very high level? So when you're talking of a founder market fit, the key thing is the market. You're seeing that, is there a real problem in this market? And then you're saying, okay, I understand there are problems in this market, but is this team the right one to solve that problem? And when you're seeing a market, you're talking about a customer segment, you're talking about use cases, need states, and so on, right? And the value chain in that particular market. And what you want to see is you want to get a founding team that can understand this market or already understands it even better, and is able to pinpoint that problem and how to solve it. At this point, you don't know how you're going to solve it or what the product is and so on. You're just trying to figure out what is the problems that exist in this market. The second stage of the fit is, if you were to build a product, let's call it product one, then will customers love this product? And we're not talking of liking the product. There are a lot of products that just get liked and then they fizzle out. What you're talking about is deep love for the product, right? And then after you figured out that fit, the product channel fit is the question, is there a way to reach many such customers who love your product? Right? And then comes the channel model fit, and which is that if I were to sell this product to these customers, that's the market, via this channel, then is there a way to make money that is self-sustainable? By that I mean, is it contribution margin positive by and large? So this means that if you can figure this out, then you have a product, you have some customers who love it, there's a way to reach many such customers, and you're able to make money at a unit level. And then the final fit is, and the way to calculate, by the way, this is, there's many ways to do this contribution margin. Most businesses, there will be some kind of revenue you're making per paid user, and you subtract the acquisition cost and the operational expenses, and you're left with a contribution margin, and that should be positive. And the last one is, yeah, it's unit economic positive, but is it a meaningful market? Can it reach meaningful scale? And for that, this has to be a pretty sizable market. And the way you typically will calculate that is the market size has a certain, you can get a certain penetration into it, and the number of customers into the number of the revenue you can make per user. That should lead to a sizable number. And in the VC game, you really want to make sure that this gets to 100 million plus revenue. That's when, not that it has to reach there, you might get exit before that, but it has the potential to be that market, right? And because if you don't get there, then it's unlikely that you'll ever IPO. And if you don't have a path to IPO, the acquisition possibilities are smaller, et cetera, et cetera. So there should be a pathway to get to at least 100 million in revenue. And as I'll discuss later, it's not easy to do that. Many products, many markets, many channels, many models will not yield $100 million revenue potential. And by the way, this is we are talking about what the VC wants to look at. If you're running your own business and you don't take VC money, you don't necessarily need to find the scale fit. For example, a few $1 million revenue might be totally fine if it's bootstrapped, self-funded business. And you can make, if you're making good cash flow or you can reach a certain amount of scale, that's a very good outcome for an individual. But it may not be a very good outcome for a VC, right? So you have to look at all of these questions if you are an investor. So here is an example, right? And the example is a company that was incubated. Actually, that's not the correct term, but it came about in the venture studio, Craftworks. And the company's name was called Spacejoy. But the thesis had started even before I met the founders. And the thesis was that, a little bit of background, at Myntra, we had started a project called Moda Rapido. It's actually a brand on Myntra that you can buy. And Moda Rapido idea was that instead of going through the rigorous process of creating designs and manufacturing them and so on, can we have an AI designer that automatically designs clothes? Right? That sounds like a far-fetched idea, and it is. But actually what we realized that 80% of it can be done. And that brand, by the way, still exists on Myntra. You can buy clothes of it, where most of the design work is actually done by an AI system. And that led to many follow-up thoughts. Like once you've built a product, you've kind of pursued many difficulties in building it, you start realizing a certain thing about the world. And one of the realizations I had when I started the venture studio was a lot of what people think is creative work is actually just grunt work. And 99%, like somebody said, 99% inspiration and perspiration and 1% inspiration. Creative work is a lot like that, most creative work. And so a lot of what you think is creative is actually, very, very rudimentary basic work. And so the thought was, hey, if that can be done for fashion design, then you can take almost anything in which there's /design, and you should be able to do interesting stuff there. So interior design, software design, anything design, you should be able to, crack all of those markets. So this was a cut at, I had a thesis called that everyone would enjoy living in a beautiful space, right? And from that started this project, which eventually became a company called Spacejoy, which is that, hey, can you decorate your room, redecorate your room for $49, right? And this is the kind of output it would provide, which is, here we'll reimagine your room and you can then buy all of this stuff because we'll point you to the online places where you can purchase it. And then you can enjoy your space. So hence Spacejoy. Right? So that's the startup. It's actually doing quite well. It's still, it's well funded, etc. So, if you look at this particular example and you look at all of those 5 fits, here's how, I'm not going to go into the details of it, but I just want to kind of give you a framework for how you might think about such a thing, right? So let's see, click through. So we started out with the market and said, okay, which kind of market would you really, solve with if you had a product like that, right? You could tackle, India, new apartment buyers. You could tackle the US home renovation market. You could target the new home buyers in the US, the people who are renting apartments in the US and hence don't want to spend a lot of money on design, but would love it if it can be done for $49. Or you could go B2B2C. You could sell the software to interior designers or to furniture selling e-commerce companies, right? All of these are potential markets. And I won't go, and similarly, like suppose you are going to target a certain market, then what kind of founder skills would you want? You want people who have interior design background, some domain knowledge. You might want people with tech skills. You might want people with US B2C sales if you're going to attack the US market, etc. So there's many things you can put in saying, okay, which kind of founders, which kind of market. But I probably spent like 3 to 4 months just kind of figuring out these markets, looking at different kinds of talking to different founders, startups that already existed, and so on. And then came the product ideas. What kind of products could you build? I'm a technologist, so I was always thinking of something technology, but it didn't have to be pure tech. It could be that I'm just going to build some software and offer this design technology to other companies. It could be a design service, which is that it's not just technology, but I'm going to hire designers as well, couple them with the technology and offer you your room being redesigned, right? Or it could be full service interiors, which is not only are we going to design it, but actually people are going to physically come to your house and install stuff, right? And all of these 3 models are totally viable products. And when you look at the channels again, how would you get customers? You can get them through SEM, you can get through word of mouth, SEO, PR, etc., etc. And there's probably more as well. And finally, what is the model? You can charge them design fees. You can lead them to e-commerce sales and take a lead gen fee. Or if you're going B2B, you can just purely as a SaaS model charge for the technology. Right? All of these are viable choices at all of these levels. And over time, right, you have to figure out which market is the best, and that has to be the starting point. And finally, me and a few other people who are working on this, we honed down on the US home renovation market, not new home buyers. I can go into why not, but there's lots of idiosyncrasies and nuances to the choice. Right? And then once you figure that out, you say, okay, the key skill to pivot on is US B2C sales. Because if you look at examples, India has a lot of technologists. India actually has a lot of interior design domain knowledge also. But India doesn't have a lot of people who have experience with selling a consumer product while they're seated here. And that is almost a very, very unique skill. So if you have to pivot anywhere, that is the founder pivot to look for. And amongst the 3 choices, we made a choice to look at the design service as an angle. Similarly, go via the content SEO route and to target a model of e-commerce furniture lead gen. Right? Now, this is the set of choices we made. And it's very thoughtful about how and why you're making these choices. And because each of the choices makes kind of constrains the other choices. My fundamental problem with a lot of founders is that they start with the product and then they randomly choose the other ones. Oh, maybe it could be this, maybe it could be that, maybe it could be this. Oh, I'll do this one, then I'll try this one, then do that one, right? And it's not that you're not going to pivot and do all of those things. But every one of them, if you don't understand the linkages and the connections between them, you're not going to end up with a consistent product. Because if you know this path, then your product is going to be designed well right from the beginning. You're going to try, you're going to use the right design language, the right product knowledge, the right, hire the right team, etc., etc. So the chances of success become much better if you have mapped out the entire path right from the beginning. Okay. So I'll pause here. Any questions so far?
Like, I have a question. Like you just made a comment that often founders pick the product first and then they kind of overspit most other parts of the equation, right? So in this case, like let's say there was an idea to start with. So you're okay with like picking a particular, let's say somebody builds an MVP or somebody was interested in building a solution, then the solution can still be the starting point as long as everything else aligns.
Yeah, see,
Out of the basically, sorry, Maya, I'll reword my question. My question is, out of those four pillars or four corners of that Bardo's model, which one do you start with?
Yeah, see, at the very beginning is a very high level thesis, right? And a thesis is an ideation stage where you can be building even product at that time. You can be building, a slide deck at that point, etc. And you're going to use something to present to other people and bounce off the ideas. My the concern I have is people start thinking of that as them having built a product, right? What is at that point is, I would call it an idea, right? And you can spend, by the way, 6 months on that phase itself. That's totally fine. It's after that stage, in order for you to actually take sizable amount of money, when I say sizable amount of money, I mean something any more than 50K, right? At that point, you need to have all of this mapped out. So I didn't want to go into the venture studio as a part, but in the venture studio, when we started 8 projects, our idea was that there are going to be 3 gates. So in the first gate, we spend 50K to reach that gate. And that gate, you can do any damn thing you want. You can, read up, you can talk to people, you can just, getting a salary, and that's what spending a 50K for a few months, right? And typically I would get in a bunch of people, I would employ them and pay them 50K for a certain amount of time. And they would, ideate, build prototypes and so on. At that stage, there's no product, even though they often think of it as a product, it's not, right? And after that gate, then we unleashed another 100K. And at the end of that 100K, all of these 5 boxes would have to get ticked. Right? And by that time, I mean that, we have identified exactly what is the market, what is the founding team, what kind of product are we building, what is the channel, what is the model, etc. Right? And then we would spend the last 50K for raising money, right? I think that even if there wasn't a venture studio and you were doing it yourself, to think of that in those 3 stages. The first part is just exploring and not, I actually discourage founders from even incorporating a company at that stage. And so you need some time to just actually think about whether this is a good idea or not. Why should I spend another 4 years of my life doing something that's a crappy idea, right? So you need some time to just ideate, and that's the ideation phase. And then in the second stage, you have to take all of these 5 boxes out before you actually then put in a few hundreds of thousands or millions of dollars into your product.
Makes sense. Thank you very much.
So Shamik, wearing the early stage VC hat, would the VC be looking at all 5 boxes to be aligned well before putting the first check? What level of validation? I don't know if you're going to talk about it probably.
Yeah. So I'm going to talk about it more in the fewer slide, but I'll answer the question anyway. The thing is, what you're looking for and what you will get are different, right? So you should look for all of these 5 boxes. I have not seen a single startup, and I've probably talked to a few hundred in the last, 6-7 years. I have never seen a founding team that has come with all of these 5 boxes very clear in their mind. Typically, so this is what you're looking for, and the more boxes you see ticked, the better you should feel, right?
Right.
But realistically, most of the time, you will see that founder market fit, and you won't even see the product market fit at the seed stage, which is where I operate, right? At the Series A stage, people will want that product market fit as well, and they would not have seen the other fits. But if you look at the good early stage investors, I mean, I worked a lot with Subrata, who's come and talked here, and I see how he operates, right? one of the hallmark of a good investor is they will seek what is the fit is there, and then they will ask a lot of questions and reference checks to see whether the potential exists for the other fits to emanate over time. Right?
Got it.
And so you won't see those fits, you can't validate the fits, but you get a better sense of whether the fits will emerge or not.
Makes sense. Thanks.
Shamik, just on that one, just trying. Go. This is Amit. When you say you're sort of trying to do validation around those fits to emerge, as an investor, do you have a clear sense of what an answer there could look like, or you're sort of signing up on this journey with the founder with the belief there's something out there and together you'll find it?
Yeah, so you are kind of signing up for the journey. However, see what you can, in this game, right? You can see the green spikes and you see the red spikes, right? You have to avoid the red spikes and you have to find at least 1 or 2 green spikes in that deep flow machine, right? The mathematical model I showed you before, there's these rows of dots coming at you, right? It's like those, video games in which you have to dance steps and you have to step on the right things. So what you're looking for is that you have to find a big green spike and you have to avoid the red spikes, right? So when you're looking at all of this analysis, you want to make sure that you're not heading down a path in which there is a red spike. So you want to eliminate that, right? So to that degree, you can make a predetermination that I know in this business that there is no way that even if you get the product market fit, you're not going to get the contribution margin positive. And hence, I'm not going to do that investment. So for example, a lot of, a very prime example of that is B2C content for Bharat, right? India 2, so to say. Now, this is a space in which, and I don't know if it's true or not, but a lot of VCs have taken the position that, yeah, you can get product market fit, you can get, product channel fit. We know that that can happen, but you're never going to get contribution margin fit, right? And hence, for us, that's a red spike. And hence, no matter how well you're doing in the first 2, we're not going to invest because we know you're going to fail at the 3rd step. Right? So you as a VC can make that determination and have your own thesis about how each market, what kind of fit will evolve.
Got it. Makes sense. Thank you.
And this is a very rough correlation of which kind of fit you are seeing at what stage, right? And all the incubator and labs, they kind of operate even before the founder, right? There is no company to invest in at this stage. And then founders come on board and then they find the seed investment, et cetera, et cetera. And then, you have various product market fits. Now, remember, this is not a one-step, it's not usually a very smooth process, right? Any company after raising seed funding will do a lot of, product pivots and so on, trying to find that product market fit. And even after they've got the product market fit, that is that they have some customers that love them, they're not able to figure out how to get many such customers, and they try out many different channels and even variations of the product to get the right channel fit. And even some late stage companies go through a complete pivot to figure out a new kind of overall fit. Okay. So the first one, founder market fit, I will not spend a lot of time. I know that other speakers before me have spoken about this, but the high level question you're asking is there a real problem here? And why this team, right? And there's many things you can be looking at this point. What is the value chain? What does the P&L look like? And this is what I would ask, I would hope that any good VC has done even before they've met a single founder in that space, right? They understand that space very well. They've talked to thought leaders. They understand the trends. They understand the value chain, the competition. They have talked to customers and understand what are the problem sets in this area, etc. And so when the founder comes along with a certain idea, you already are well aware of not exactly what the product should do, but you understand the problems. Right? And then when you're looking for those same founders, a founder comes out in this market, then you're trying to validate whether they understand all the nuances of the market that you do, right? And if they are very novice founders and they don't understand the market, you're looking for the learning ability to see whether they can quickly ramp up. Because unless in steady state, not right now, but eventually, they understand the market and the customer better than anyone else in that space, they're not going to win. So you're looking for either already pre-existing excellence or the path to excellence. And secondly, you're looking for whether they have this ability to find the product. Because reality is when you go out, talk to customers, talk to users and so on, they will give you a lot of signal and noise, right? And you have to be able to figure out what is the right signal, and all of it is, most of it is noise, right? So that judgment and taste, right, in a good product thinker is not very common. And of course, they have to have the ability to actually build the damn thing. The things below the lines are what I call nice to haves. And again, people will disagree with me here, but you have to be able to tell the story. And the reason I have it as a nice to have and not an essential is I find that, especially younger founders, they build the skill over time. And who you think might not be a good storyteller, they can with practice suddenly, I get surprised like, oh my God, this guy is telling a pretty good story now 2 years later than what he was, then. And that they can scale and build a team and so on. And again, this is an ability that I've seen develops over time as well. So product market fit, right? So this is kind of the main thing that most people will talk about. I will focus on another aspect as well, which is the product channel fit, which in my opinion is even more important than the product market fit. So anyway, the product market fit is quite well understood. It is basically either if you have some customers, do the customers love this product? Or if you don't yet have the product, will the set of customers actually love it, right? And how you judge it, there's many metrics, engagement, attention, blah, 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 a lot of them, right? But I'll talk about what you as an investor might evaluate wrong. And I see mistakes. I myself make these mistakes all the time. And you have to catch yourself. So first of all is averages, right? So all of these metrics are averages. And remember, what we are looking for at this point of time is not profitability. We're not looking at go-to-market. We're not looking at how many customers you have, not looking at how much money you can make, none of that. We're looking for a small number of customers who are absolutely, adore this product. They're talking to their spouses, their girlfriends, their friends about how they use this product. If you call them up, they say, oh, you're the founder. Oh my God, I love this product. You have to see that kind of emotion from that, right? And when you look at the averages, that's just going to get hidden and get masked. So you get a rating and it's 3 out of 4, you're depressed. What you don't know is that maybe in that pocket, there is some pocket that actually has a 4 on 4 and the rest of it is 2 or 1 out of 4, right? And what you're really trying to find out is, does this product have that set of absolutely enthralled users, right? And because it's just as much as it's about making a great product, it's about finding the right market, right? And once you kind of found that market, then you can slowly expand it. Second is that you're looking at the product and the metrics don't look that great, and yet the product may not be complete, right? And there's like 1 or 2 features that are missing. And while you don't want to be feature creeping all the way through, often like one thing can change the game a whole lot. And I've seen that with some of the startups I invested in. They kind of chug along for 2 years and nothing really great is happening. And then they build one feature, they focus on a smaller market, and then suddenly things explode. The third thing is some products need time. And just because it's a hard problem or it is primarily a word of mouth game and so on. And the metrics that you're looking at right now will not remain the metrics over time. So the last 2 points are the intensity of the engagement is much, much more important than the volume of the engagement. And the last thing to be aware of on the negative side is there just a herd effect, right? Is it just a trend or is there a fundamental shift? And both of them look very similar in the beginning. And I don't want to say that as a negative that, oh, a lot of things are fads. There have been many cases in which what I thought was a fad was a fundamental shift in human behavior, right? I'll give you an example, right? I had the chance to join Facebook early on. And I was like, oh man, social networking. I worked on social games and this, that, it's going to be a fad, right? And now, 12 years later, we see like, okay, my God, that's like a fundamental shift in human behavior. Right? So you have to be careful on how you're judging this, and really it comes down to judgment. Okay, I'll pause here. Any questions so far?
Maybe we can move on, I think, yeah.
I'll just move on. So there's a subtext to this slide saying, the way you kind of find this product market fit is you build a subpar product for a market. And the reason for this is that, nobody can match the best and all the features of whatever the market needs in the beginning. So you can't wait for perfection. So you have to build a sub product for the market. And then you have to find a sub market for your product, which is that often you don't know exactly what your market segment and customer segment will be. So you have to build some product that's kind of, not necessarily perfect for anybody, but that allows you to get involved in the market. You can now start having conversations and getting user feedback and looking at customer behavior, doing analytics and so on. And then that gives you a way to find out which pockets of customers have unmet needs. And then that is the sub-market, that is the golden one. And then you build your product and enhance it, focus on that very specific sub-market. And there's a very good article that the CEO of Superhuman, the email product, has written, which talks about this phenomena, right? That just as much as you're building your product, you're also finding the market, right? And both of those have to go hand in hand for you to be able to get that fit. I'll give you an example of Myntra itself, right? So the product itself was not changed a whole lot since its founding in 2007, which is that you can buy and sell fashion online, right? So they will buy the products from somebody and then they'll sell it. And not many know, but initially it started out as a B2B player. So you go to Infosys and say, hey, all your jackets, you want your Infosys tag on it and give it to all your new employees, we'll provide you that. And from that, it pivoted over into B2C. And so from these corporate gifts, it moved into personalized products. Oh, you want to go for, this World Cup happening, you want an India t-shirt with your name on the back, you can get that at Myntra. From that, it then pivoted into branded products, right? Saying, oh, no, we don't do personalized products, we do branded products. Like, you can buy, Biba, W, Global Desi, Nike, and so on. And then it went further in and found that really the first product market fit was in branded shoes, athletic shoe wear, Nike, Puma, and so on. And there's a lot of analysis you can do on why this was. And if you look at it, shoes are relatively commodity products. The sizes are standard. You tend to buy, you stick to the same product, so you don't worry about sizes. It's a boxed product, so you don't have to, even if you go to a store, they're unlikely to let you try one. So the online versus offline in 2012 or 2010 was not very different experience when you bought branded shoes, right? And that was the very first product market fit that evolved. And from that, the customers then migrated and became more and more. Right? But this is typically the journey that any company would go through to go and find its product market fit.
Hi, Shamik.
Yeah, go ahead.
Sorry, this is Arushi here. So something that's surprising me about your rationale is that I always thought that the product or sort of the product is defined by the problem you are solving. But you seem to have flipped the script almost by saying that the sub-market is defined as you go in niche into different areas, right?
Right. So good point. And this is why the previous slide, I said that your product has to be for the market, but the sub-market has to fit your product, right? So it's a two-stage process rather than what people typically think of, or you find your market and you find your product, right? So if you look at in that particular slide, like the market that you have overall is soft goods. And if you go back in 2010, the fact that you could sell soft goods as opposed to books and electronics online was a relatively uncommon phenomenon. Actually, even in the US, there has never been a success story of selling soft goods online. Right? So the market was soft goods, the product was e-commerce. right? Now, this at that time, if you looked at it and said, oh yeah, soft goods product, both of them are clear. But so you built a product that allowed you to sell soft goods. But then you discover that the market is actually pretty, has many, many nuances. B2B is different than B2C. B2C has personalized and non-personalized. It has ethnic versus Western wear. Western has clothes versus shoes, et cetera, right? So you build your product, and now that allows you to operate in this market. And that is what you are saying, right? Hey, I thought you had to build the product for the market. Yes. So you have to build e-commerce, you have to build search, you have to build filters, you have to build payments, you have to build COD, you have to build warehouses, all of that stuff. But once you have built it, you find that the entire market doesn't resonate with your product. There are some people that love it, some people hate it, and so on. And then within that market, you're operating and finding that sub-market that really resonates with your product, right? And it's not that your product has stayed constant as well, it's also morphing, but it is morphing within the market.
Got it, thanks.
So, this is not very uncommon for any founder that has built a successful company, because, and it's actually not uncommon for people who have built, failing companies as well, because eventually as you're going through this journey, you run out of time, right? Or you run out of money. And, I would say vast majority of startups, 9 out of 10 or 7 out of 10 or some number like that will fail at this stage, right? And when this thing is happening, if you look at all the successful people, they would have also gone through the path. The ones that have failed, they will also gone through this path, because this is the essence of startup building, right? But when you look at it, as an investor, because you're the judge, you're the guard, you don't have to do the shit, right? You look at it, and I find that I myself have this flaw that, I look at it and you tend to be very judgmental about founders as they're going through this, blind man's, feeding the elephant journey, right? And, you will find that, the same thing can be looked at and talked about in two different ways. The skeptic will say that, oh, this team has no focus at all, right? And the ones that are the believers will say, oh, wow, look at how agile they are. Look at how they're pivoting quickly and moving around and finding stuff. And some other people will say, oh, look, they're being very analytical about it. Each step, they're able to analyze the customers and figure things out and so on. And then as the data shows that they should move from one to the other, they move there. And the skeptics will say, oh man, they never have conviction about something, right? You should be operating with your gut, your intuition. Data doesn't reveal itself at this point because it's so sparse. You just have to plow through a little bit more, right? And perhaps if Myntra were to just do corporate gifting and corporate gifting some more, it would eventually break through. And then there is the same question that Arshi asked, like, is it the product first or is it the market? Which do you stand more true to? If you defined corporate gifting as your market rather than soft goods as your market, then you have to stay true to that market, right? Because that's what we said, what it's all about. Your product fits that market and then you pivot within it. But if you define the market as soft goods, then you're allowed to pivot within it. So what is the market and what is the product? You have to be pretty clear in the beginning. And the more the beginning it is, the wider you should define the market. And as time progresses, you have to narrow down the market more and more. So there's no true answer. There's no right or wrong. But I'm just conveying that these are the conflicting emotions that will come to the investor as they look at that founding team kind of struggling through this journey of trying to find the product market fit. And my own experience has been that you have to be patient, and you can be guiding at this point, but you cannot direct people, because this journey is difficult, and it is most likely to fail, but the ones that succeed then have a very big outcome, and that's what the whole VC game is all about. All right. Any questions so far?
Hi, Shamik, Shubham this side. I had a quick question. What you've described is very pertinent and common for B2C startups. For more deep tech B2B startups, where you can't sort of pivot and you have to you can't subdivide and go into a market very easily. How does this play out in that space? Are there any other sort of playbook?
No, I actually disagree, Shubham. I was a co-founder of a B2B SaaS company, security software. Started a company in 2001, market crashed. And then we spent like almost 4 years, and pretty much all my gray hair came at that point, right? So, you know, it's a very similar process in my mind, because the market that we defined at that point was security software for large companies that allows them to communicate with other companies in a secure manner. And once you kind of define that, say, oh, actually, you know what, this problem is really only in 2 sectors where companies need to exchange a lot of documents with each other. We had said it's for all companies, but actually it is mostly for manufacturing and finance. These are the only 2 spaces in which a lot of documents get transferred on a daily basis. And then we said, oh, you know what, manufacturing companies, their documents and processes are very well standardized, and they already have EDI for doing all of that. So unlikely that they will rip out all of that stuff and do this. So then it's left you with finance. And then as you look at finance, finance actually has many sectors within it. There's investment banking, blah, 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 retail broking, and so on. Then you say, oh my God, okay, this is the problem for that space. And finally, we honed down into retail banking. So it became a product from securing intercompany communication for all large companies. It became a product for security software for retail banking, right? Which is a very different product if you look at the final feature list that comes out.
Okay, thanks.
So this is where, you know, and see, all ecosystems need to mature, and maturity happens when, you know, previously, if you try to start a company here in, you know, 2005, 2007 in India, like I did, you'll find that the ecosystem doesn't even have founders. It doesn't have VCs. So there's no question of even finding founder market fit, right? And now the question has evolved to shift towards mostly product market fit, because there are lots of founders, a lot of startups. Early stage financing is relatively easy to get. There are lots of, you know, early stage funds also. So many companies are now at least trying to build products for markets. Some of them get product market fit. That ratio is more different, in my opinion, than in the West. That same 30% maybe companies get that product market fit. But we don't have enough companies that have gone past the product market fit and hence that fail at the second step. Right? It is now starting to happen, but not in large numbers. And this is the second hurdle. And I find that in India, at least now, this is the hurdle that not a lot of knowledge has built up, systemic knowledge. Like you can, you know, get lots of PMs now who have built product market fit products, but you can't get a lot of product managers that have gone through the product channel fit, and hence it hasn't become part of our psyche. But what product channel fit is all about is there a cost-effective way for this product to reach many target customers? You already found out who your target customer is like, what's their profile and so on. But you haven't figured out how to reach them at scale. And the typical answer you will get when you talk to founders is that, oh, I'm going to try SEM, then I'm going to try SEO, then I'm going to try, if it's a B2C product. If it's a B2B product, then they'll say, oh, I'll try feet on the street, and then I'll make a lot of outbound calls. Then I'll set up an inbound thing, you know. And reality is that, you know, there's a Pareto principle, and 80% of all of your go-to-market will happen through a single channel. And what is that channel? And the reason it is so important to identify that channel is your product has to work for that channel. Your product has to be designed for that channel. So for example, if it is going to have organic growth and virality in a B2C product, then that virality aspect has to be the core thing you build first, even before you build the features, right? And similarly, if it's a B2B product that you're going to sell by feet on the street, salespeople going and visiting it, then it has to be very well integrated with the rest of your ecosystem. And almost you start off by having distribution partners, other large players that you're well integrated with who can go and co-sell it. Right? If it is a very small value product, then the product itself has a very low friction in an onboarding freemium type model where people can download and use it and then they pay for it, etc. Right? So the product itself has to be built for that channel. And this is the thing that I think is missing in a lot of startups today. The fundamental principle to use here is that products are designed for the channel. Channels are not designed for the product. You can't build the product and then say, oh, I'm going to use, I built the product, I got a few customers, now I'm going to figure out which channel to use for, getting marketing for it. So the marketing is kind of the core essence of the product right from the get-go. And there are many things you have to think about when you are designing the product. What is the key proposition that you're going to make on this channel? So for example, if the proposition is complex and you only can do an SEM ad, you're not going to be able to convey that complex proposition on the SEM. So the SEM channel doesn't work for a complex proposition, right? So you have to have the key proposition and you have to have an idea about how you're going to convey it. How are you going to drive trials of the product even before people buy it and pay for it? Is there going to be a demo? Is there people can download and play with it themselves? Can they create accounts? If it needs a whole team before the value is apparent, then how do you showcase that, etc. The onboarding has to be very different. For example, if it's a low value product, you cannot spend a lot of money and time on onboarding. Is there virality? What is the cost structure of it? Is it going to satisfy the channel? Right? Because every channel has costs. So is the cost structure of the product equivalent to the cost of acquisition for that channel? So all of these questions come up and you have to answer all of this. Here's two contrasting examples I'll give you from my recent past, and these are B2C, understandably not deep tech, but it's not meant to convey the exact details, but the framework for thinking about it. So many of you might be familiar with this brand called HRX. This is actually a brand owned by Myntra, so it's a private label, which is co-owned by Hrithik Roshan, right? He owns a small percentage of the brand. And the product's value proposition is pretty simple. It's good sportswear, very affordable. So effectively, it's the same as the Decathlon product, right? So you get a Decathlon t-shirt, it tends to be very cost effective and a pretty decent quality. So this was the value proposition. But before we get into it, you have to look at the channel and say, how am I going to make this brand popular? What is the proposition? How am I going to convey it? And then how am I going to drive trials, right? So for HRX, this thing was very simple. The awareness is going to be through Myntra banners. It's a private label product, so we have the traffic, and we're going to convey this through banners on Myntra. The target audience is basically young men that like to bodybuild, right? So they have muscles and so on, and they want to look fit like Hrithik. So that's kind of the key proposition, right? And because of this, the product has to be designed for that, right? So that means that these t-shirts tend to be cheap. Remember, these people are on Myntra, so they're seeking discounts. 80% men, so the product is designed for men. It is not loose fitting like the Decathlon product. It is body hugging. Why? Because it's targeted at people who want to look like Hrithik and hence want to show off their body, right? So hence, the product has to be designed for this channel. And in order to drive trials, we'll have discounts, right? So this is the kind of key proposition. And because of the proposition, the product is made in China. The fabrics tend to be cheap because you have to make the product cheap because these are discount seekers. The products have to be, figure hugging. They have to be colorful because you're going to promote it on Myntra, where there's a lot of other brands, and hence the product has to jump out when you have a list page with lots of products. And hence, all of these things are designed into the product. So my point is that the product choices are coming in after you've figured out both the market and the channel. And then within those two constraints, then you figure out how does the product fit the market and the channel, right? Not that you first get the product and then you figure out what's my market and then what's my channel. Now I'll contrast this with another product that I worked on recently, and this is Cult Sport. This is a brand that PureFit promotes to its users. And the proposition might look very similar to you at a very high level, but once we dive in, you'll see how different it is. So this is product. It says it's premium workout wear for Indians. Okay. And here, there is no celebrity. These products tend to be relatively more expensive. We are targeting at people that want to buy a Nike product of 2,000, 3,000 rupee leggings, but we are giving it not at HRX prices of, let's say, 800 rupees. We're charging about 1,500 rupees for that same product, or maybe 2,000 rupees. And so it's premium product, right? And again, you have to, how do I drive awareness? How do I convey this proposition that it's premium workout wear, not sportswear? And how do I drive trials? So the awareness is through CureFit app and centers. So at fitness centers, you'll have hoardings, you'll have banners on the CureFit app, etc. The imagery is not about a celebrity. It is going to use workout positions and workout motions. And you're going to drive trials by bundling it with your membership. If you buy a CureFit membership for going to the Cult Fitness Center, then you get so many products along with it. Or you can buy the products at a discount if you've got your membership. Right? Otherwise, the products, if you just buy them off the scratch after your first trial, they tend to be pretty expensive. And if you look at the messaging, right, the messaging is also using Indian languages. Don't adjust, right? This adjust Marty is an Indian phrase, right? So it's playing off of that word. It's meant to kind of indicate to women who are working out, who are more than 50% of cult users, that look, most of the existing workout wear will require you to constantly adjust your clothes while you're working out, whereas here you don't. Right? So it is directed at the Indian users with Indian feelings and talking more about the fit and the fabrics and so on. And because the product is priced highly, you can afford to use very high fabrics made at very good factories with very good processes, etc. Right? So again, the product has to fit the channel. It has to have a messaging that can be conveyed on that channel. So before we move on, again, I'll pause here to see if there are any questions on this product channel fit concept.
No question, Shamik. I think just one more of an observation. I think it was very interesting. I would have at least, till you took us through these two thoughtful examples, imagine the channel in both cases was a proprietary online sales channel. Like both of these are private labels for their respective platforms.
Yeah.
And they're on a proprietary platform. But I think maybe still need to absorb this a little. But what I'm hearing from you is there's a lot of nuances beyond just that one statement of what the channel was.
Correct, right? So to give you a more, tech B2B example, right? So for example, Spacejoy, right, is an interior design tech company. We don't like to anywhere say that it's designed by AI because that just again takes away from the value that you're getting, right? If you think that, oh, this room was designed to me by a bot, just hold on, I think somebody is very persistent. Yeah. So, but if you go to Spacejoy, I would say 70% of the work of designing that room is done by technology, right? And so there, again, there's many choices, right? You can actually get to more efficient design by selling this product to interior designers. So that's one channel. You can sell this product to consumers by directly going out to them via content and PR and branding and so on. The third way to get the same set of customers is by going to e-commerce sites and saying, we are going to embed this product in your furniture buying experience. And in each of those things, the product choices you make will be very, very different. So, and actually Spacejoy did make some choices. I'll give you an example of how it pivoted in that product channel fit. Right? So the very first incarnation of the product was actually almost like a game. It was an app on the Play Store. In fact, you can still download it. It's called the Spacejoy app. And it allows you to take a room, you just give it the dimensions, and you can stretch it with your finger so that it kind of mimics your room. And once you kind of build up a floor plan, it builds up a 3D version of that. And then you just throw in a sofa and it puts it in the right place. You put in drop in a picture, it just knows which wall would probably make the most sense and put that picture on that wall, and so on. So it kind of snaps things into place, and with a very little work, you can design your room, right? And that's also a B2C play, right? Whereas now, if you look at spacejoy.com, it says that, no. We are not telling you this is all a bot and all of it's tech. It's just like a service, right? There's a guy behind it. And in fact, once you kind of register there and you say this, somebody will call you and say, oh, what kind of styles do you like, and so on. So we are putting a facade of a human in front of it. Because the channel that we were going through directly, which is the Play Store, we found several issues in the monetization part of it later on, right? And we discovered that in order for somebody to actually pay for it, They don't want to see that, oh, I did all the work, why should I pay you, right, for the technology? If they feel that, okay, you provided a service, then so the product offering itself is different now. It's not a piece of technology. It is a service that does it ridiculously cheaply. You don't know how the heck does it do for $49, whereas the interior designer usually takes $1,000 for a room, right? Now, that is the proposition to the customer. So because the channel has changed, the product itself is completely different. Did that answer your question?
Yeah, no, absolutely. I think one of the reasons maybe a lot of us are a little quiet is we're just trying to digest. It's quite rich, and I guess, at least for me, trying to just digest this a little bit more and visualize.
So I know we're running over time, so I'm going to skip over the next 2 slides, but I'll just kind of talk about the gist of it, right? The gist of the channel model fit, and this will, we don't want to overemphasize this because this happens in the later stages of the company's growth, right? Once you are looking at the CAC, and you can read up on this on the Balfour site as well, the link is at the bottom. Not all possible combinations of customer acquisition cost and revenue per users work. There are some things called the dead zone in which, you know, no matter how many people you can acquire at a certain cost, you're never going to make the revenue to make it work, right? So you have to be just careful that, you know, founders that come to you are aware of this, and they're operating at a viable point in the search space, right? And there's a certain CAC, there's a certain RPU, and not all combinations are possible. Only certain combinations are possible, and that you're operating at one of these viable segments. And the last one is model market fit. And this is again a relatively obvious slide, but there's, you know, there's 99 ways to die. There's a song that called by Megadeth. And, you know, the common phrase that you hear in the VC world, at least in Silicon Valley, I've heard it not, there's only 5 kinds of companies that exist, right? And it's largely true. I mean, it's a little bit more of a exaggeration than complete truth, but by and large true. And this says that in order to reach $100 million in revenue eventually, there are only 5 possible combinations. And this is basically a simple multiplication of how much revenue you're going to charge per user and how many customers you can have in the steady state. And the usefulness of this to a VC or investor is, oh, if the final answer, I don't care about what you do, what product, what market, what channel, anything, at the end of the day, you're going to fit into one of these 5 boxes. And you look at all the public companies as well, and you look at all of their pathways to 100 million revenue, they would have fit into one of these 5 boxes. So hence, you know, most likely true. And what this framework kind of makes you think about is, oh, it doesn't almost matter what product you build. What at the eventual thing is, you have to understand, are you building a $1 million product that every customer pays for? Are you you're building something that people pay $10 per customer? And if so, how many customers do you need for this to reach $100 million in revenue? And once you look at that, that's kind of simple, you know, multiplicative math. But once you look at it and ask a little bit deeper questions, is this product ever, even if it's full glory, ever going to be worth $100,000 to a customer? And you have to put your hand to your heart and say, man, I can never see this becoming a $100,000 product. And then you should be skeptical irrespective of what the product in the market is, right? And similarly, if somebody says that, oh, I'm going to make money by charging people $1 per user or making money through advertising of $1 per user, then you're going to need 100 million paying customers or advertisable customers in order to make 100 million in revenue. And that is hard too. So both ends of the spectrum are hard. And furthermore, to make it worse, there is that dead zone in the middle. I haven't put it in this slide, but there's a dead zone in the middle. So you are in effect left with very few places that you can actually operate in. And what this also indicates is that your product, if it's at the top zone, whether you want to make it a pure product or not, is going to end up with a full service product, because anybody who's paying you $100,000 per year is going to want you to respond to their phone calls. When the system goes down, they want you to jump on or fly on a plane and get there and fix it, et cetera, right? So it will end up being a full service product, no matter what you position it as. And similarly, if it is going to be less than a certain amount, then for your business to exist and to sustain itself, it will have to be a self-serve product. Right? So these are the 2 places that things will gravitate to. So your product has to be designed accordingly once you know what space you're going to operate in at the steady state in 4-5 years, because that's how you should design your product from the get-go. And for a VC, you look at this chart and you say, okay, can this particular idea have so many customers? So for example, if you're building space rockets, right, and you're going to say, oh, wow, you know what, I'm going to have, it's a $10,000 product, and I'm going to have 10 million customers for it. Everyone's going to launch their own space rockets. That's just not going to happen. Right? So then you have to say, okay, if that's the case, and I only can have a total potential 1,000 customers in this world, then I better price it at $100,000. And then if it's a $100,000 product, then I better build all of these service capabilities and customer support, and guys who are going to go up to their house, place and install it, and blah blah blah, whatever else. And secondly, once you identify it can have so much customers, you have to again do a gut check and see, will they ever pay so much per product per year? So that's all that I had. Just to summarize, first, understand the market, have a thesis, understand where the value unlocks will happen, find founder that matches this particular market's needs, see if the product is reasonable. It's going to pivot for sure, right? But do they have at least a reasonable product to go into the market with? Because after that, they can find that sub-market. Then to see whether this product idea is suited for some distribution channel at least. Is it possible to make enough money to be contribution margin positive? And eventually, can it reach $100 million in scale? That's kind of the overall Balfour framework. Again, as I said in the very first slide, don't get too wedded to it, but it just provides you a map in which to structure your thinking. Okay, that's all I had in my talk. So again, I'll pause and take questions.
Shamik, just to confirm, for early stage investing, I'm guessing we're still step 1, step 2, max step 3. That's the extent to which you can imagine and look for validation around, right? The channels, the model, etc., will evolve, I'm guessing.
Correct. Again, I think somebody else had asked the same question. There's a difference between what you can validate and what you can predict and imagine, right? So what you have to do is you have to look to see all of these steps to see whether there is any red spikes in any of those zones. And I had given this example of, for example, some VCs will stay away from B2C Bharat products, right? And that is not because they find that you can't find the right founder, you can't build the right product, or you can't get the right channel. But it's just that they don't believe that you will ever make CM positive, right? So in that case, you're validating the first two, but you have a strong thesis against the fourth one, right? And in that case, you won't invest.
Okay, got it. So at a thesis level,
Yeah, so at a thesis level, it has to match all 5 areas. And at a validation level, it probably has to match just the first 2.
Cool. I'm guessing you can also get a lot of validation from the distribution channels that the founder has thought about. It may not be in play at the point that you're looking to invest, but at least is there a plan and some clarity around what channels they will adopt eventually, and is the product shaping up accordingly and stuff like that?
Correct, right? See, the thing about channels is that you're not going to invent new channels. There are only about 10 such channels in B2C, probably 5 such channels in B2B exist, right? And each of those channels has seen many products come through them, right? So in the early 90s in the US, software used to be sold in shrink wrap software in retail markets, right? Not retail, but there were these stores called, I forget what the names are, but they were just like Best Buy and so on, where you actually go and buy these cartons of software, right? There would be a CD inside it, you put it into your drive, and that's how software is sold. And if you were not fitting that channel, right, and it wasn't a $49 product or $99 at most, then your product can never be sold, right? So no point being in the software business if you didn't have shrink wrap software that's sold through Tech Micro and Ingram and so on, right? So that was the channel, right? And you have to build your product designed for that channel. So my point is that you have to look at all the 5-6 channels that exist in your market today and you have to make sure that your product fits that channel.
So Shamik, from the early stage VC point of view, I asked that question earlier and you responded that not all the boxes will be checked, but good investors look for those signs, either through ref check or understanding the founder that this team will be able to check the rest of the boxes soon enough, or in the right time. So I guess the most critical uh, uh, characteristic of the founder would be probably learnability and how they iterate um, on each of the four corners. How well they are able to do that. That could be a strong point when you're evaluating at early stage.
For sure. I mean, I think learnability is a very strong one. There is a slide that I skipped in the beginning. I hid it. There's a car sticker I saw in the US which says, my karma ran over your dogma, right? Which is, and it's supposed to be a very tongue-in-cheek slide, a car sticker saying, you know what, you can have all your thesis and all your beliefs and everything else. At the end of the day, karma is going to happen, right? So, but there's a deeper thought behind that, which is that I've also found that, there are some founders who are just resilient and can push through things irrespective of what channel and what framework and what product market fit and et cetera, whatever you think about, right? And those founders, it's not so much about learnability as it is about resilience and fortitude, right, to get things done. So I would say yes, learnability is one of the traits, but there are other traits which are even more important in my mind.
Hi, Shamik. This is Ankur. I had a question on channel product fit. In case of HRX and the cult sport that you were talking about, first of all, these were both non-tech products to look at. And then when you go back to, let's say, the fitment on the channel product, would you agree that for both of these products, there was this channel that existed and you wanted to largely also capitalize on that channel, and it slightly had a reverse fitment than actually a forward fitment, saying
yeah, so this is actually the fundamental point, and I think I haven't been able to stress it enough because it keeps coming back. See, the thing is that you said that for both of these products there was a channel, and probably what I'm sensing behind it is, oh, you were so fortunate you had a channel for your product, right? And here's the point I want to make, right? If you don't have a channel, don't build the product, right? This is the fundamental point I'm making, that products are built. If I go back here, right? This is the point I want to make, right? Products are designed for the channel. Channels are not designed for the products. And this is why I think in the Indian ecosystem, we still haven't gotten to that point of awareness, right? If you don't have a distribution mechanism where you have an advantage or a key leg in, you might as well not build the product because you are most likely going to fail. So first, before you even build that product, identify whether you have a channel, and then design the product very much for that channel, because most startups go through the point where they can build a product, they can get to a product market. I won't say most, right? So I take that back. 30% of companies will go and build those products, and then where they fail is getting to that channel fit, right? So out of that 30%, maybe one will succeed at getting channel fit. So that is the hardest part of the whole game. So unless you have identified the channel and you have tested that channel with your product, you've designed the product for that channel, you are most likely going to fail. So why even attempt building the product until you have very finely understood the channel?
got it.
And this is actually a very deep, thought. So I would say that ponder over it a little bit. And every time you think that, those two examples I gave were kind of contrived because you already had a channel, then you're thinking in the wrong direction. Because this is the fundamental point, that you have to first identify the channel, then you build the product for that channel. For all products, B2B, deep tech, non-tech, cameras, social games, whatever else.
I think another way of saying that is that there are only so many channels.
Yes.
And so you don't build a new channel, but you need to build a new product. So, although just a nuanced thought on it, Shamik, I don't know whether you also feel the same, that discovery of this fit is not in one step. It may take few steps to do this, right? So that's.
And it's fair to call it as a channel product fit than actually being a product
That
channel fit.
may be a good idea.
Absolutely. You hit the nail on the head. That's exactly what you think about. See, the
All right.
thing is that as product builders and technologists, many of us here, we tend to put the product on a pedestal, right? हमने कुछ सोचा है बनाएंगे and अब देखते हैं कि the whole world को हिला देंगे, right? That is not how the world works, right? The market is already defined. People are going to buy shirts, they're going to buy technology. You're going to fit into the same P&L if you're building some deep tech product of some company's customers. At the end of the day, if you do sales, right? And I've been to Cleveland, Ohio in the middle of the winter trying to sell my security software product to a insurance company. And the questions they ask are very, very simple. Acha, mera kaun sa line item mein tum jaoge? And at the end of the day, you realize that for that CIO, you are just securities. They have certain line item, tech ops, security software, so on. You're going to fit into that same P&L, which is that market. Right? You're going to fill in the same channel that he already is aware of. And so if you're not fundamentally aware of all the markets and the channels, you are just kind of wishful thinking when you're designing a product.
Right.
True. Thanks, Shamik.
All right. It's 3:23. Any last one or two questions, since we have another one to follow after this?
I have a question. So for businesses where there is not a lot of freedom to pivot, for example, could be Agnikul, I'm not sure. You probably need all these things checked out right when you start, right?
Yes and no, right? I mean, yes, of course, you want to be able to have a path to success, right? So you have to figure out that, there are some customers that buy it, right? And I have not been involved in the due diligence of space. I have no knowledge about space, but I'm presuming that there are some customers, right? And that is a pretty, so you have to understand how you're going to reach this customer. What is the channel for reaching these customers, right? So you have to at least validate that there is a way, right? And not necessarily that will be the way, but if, for example, if you're not able to find any way, then
Sure.
you should not do it, right?
Yeah.
So again, it's like the green spikes and the red spikes. You're looking for the future to see if there are any red spikes on the journey. But you don't know whether the green spikes will happen or not. You have to have some green spike, but you don't know if all of the road will be paved or not. You just don't want to see the big crevasse in the way, right? Because if there's a huge canyon on the way, then you don't want to go down that journey. But you don't know exactly if it is going to be through thorny bushes or through forests or so on.
Yep.
Thanks.
Just, we, including yourself, all the speakers have put in a lot of effort to present content and speak to our cohort. So we have been supporting KVN Foundation on behalf of all the speakers. So thank you so much for your time.
Great.